And a particular welcome to Cyrus, who, like so many people working, doing interesting things in this world, did the MPhil here in Oxford in economics, and was at Balliol. Like, I was going to say, like so many people doing interesting things. And because of that Balliol connection, I've met Cyrus earlier, but that was rather late on. Everyone else in the room seems to have known Cyrus for a long time. It was a particular welcome to you coming to join us here. He's Vice Chairman of Barclays and Head of EU and UK Public Policy and Governance Public Policy and Government Relations. So think of what that means. It's I think you might think of that as importantly about outreach and public understanding. He was Vice Chairman of Barclays Investment Bank, where he had a variety of roles, including Head of Public Sector, whatever that set of initials means, and Head...
EMEA, Europe, Eastern Europe, Middle East and Africa.
A lot of places.
Yes.
And Head of Investment Banking, I see it now spelled out, all of that. He joined Barclays not so long ago, just in 2000, from BNP Paribas, where he had a number of senior roles in London. And before that, he was Managing Director at Chemical Bank. And then, before Chemical Bank, you end up where so often, I was going to say many people doing interesting things seem to have been, which is the World Bank. So he's had an international career in working about finance and banking issues, which led him back to London. He's going to talk to us today about the sort of question that many of us, not the sort of, the question that many of us have been wondering about. We all believe that financial regulation should be tightened after the mess of 5-6 years ago, and none of us are very sure how this can be done without it being a real impediment to growth. So I think I'm certainly very interested to hear what you've got to say about this question, and I suspect everyone else is too.
Great.
Thank you.
Thank you very much, Edward. Thank you. Really, I very much appreciate the opportunity to be here and to speak to you. I have to first say that it is quite intimidating to be here sitting and talking to you about these issues. I come not as an academic or as somebody who's devotes a lot of his time to deep study, but I'm a person who's involved in the industry as a practitioner, so I think hopefully it'll provide you with a perspective of what we in banking per se, how we see the world, and will provide a basis for discussion. I don't know if this thing works or not.
Is that working or not?
Or maybe
if it doesn't, then can you go back or up and down? Yeah.
There we go.
Is that okay?
Fine. Yeah, thanks. A few introductory comments. We have, over the last 6-7 years since the financial crisis, gone through a period of unprecedented change in the regulatory environment, and I'll come to that in some more detail in due course. It is without doubt having a very profound impact on the whole intermediation process as a whole, not only banks, but if you look at intermediation more broadly in capital markets, non-banking, etc., the regulatory changes have a very significant impact. I firmly believe that a very robust regulatory framework is an absolute prerequisite for sustainable growth, so the two are not in contradiction with each other at all. The pre-crisis regulatory environment, and I'll come to that, was in my mind not fit for purpose, and that was clearly demonstrated by the crisis, and actions have been taken to resolve that. Having said that, the current regulatory reform agenda, while taking a very significant step forward, continues to raise many challenges for growth, and that is what we today need to focus on, and I believe also people in Europe are beginning to focus on quite actively. Consistency with sustainable growth and regulation is possible, but I think we need to make sure that we do develop a regulatory environment that is not only focused, as it has been for the last 6 years, on stability issues, but really makes part of its objective the need to promote growth in the economy, and that's something which has not been the case, frankly, up to now. with that, let me spend just a few minutes talking about the crisis, because I think that is really quite important, because it really highlights the sort of issues and considerations that have led to the significant changes that we are seeing. There is no question that the pre-crisis growth that we had was not sustainable, and there are many, many reasons for that, why that was the case. This belief in this sort of new moderation, where we could have relatively rapid periods of growth with low volatility, was clearly an illusion, which came to an end in 2007, 2008. The crisis, when it happened, and I think it's sometimes easy to forget today, having being 6-7 years down the road, was truly existentialist in terms of its risk to the world, not only the financial sector but to the globe as a whole. It's sometimes not appreciated, but the actual impact on, for example, world output on the first year was significantly larger than the impact that occurred after the Great Depression. Trade declined by 20% in the first year, whereas in the Great Depression it declined by 10%. If you look at equity markets, they're down 50% compared to 20% at the time of the Great Depression. So the numbers were, in some ways, a multiple of what happened in 1929. GDP, for example, in the UK was down 7%, in Germany was down 12%, in Japan was down 14% within a period of 6 months. These are numbers which are really quite staggering. The impact on the EU was initially muted, but then in 2001 really brought an existentialist risk to the EU itself. And I think for some time people were really questioning not whether the EU was when the EU was going to mend itself, and when was it going to actually fall apart. What is, I think, perhaps most shocking of all was that none of this was anticipated. So you read the literature in 2007, you look at the newspapers in 2006, 2007, nobody had the clue that we were walking into what was potentially one of the worst disasters in history. Why did this happen? I think it represented a combination of many different factors. One, I think one of the factors which sort of lie behind that was the macroeconomic imbalances that existed. And we'll come to that, because that really takes us to the whole question of macroprudential management. There are significant macro balances between Asia and Europe, driven by essentially major changes in economic power. Huge savings leading to a quest for investment leading for resulting in lower liquidity, lower returns. Low returns in turn leading to higher leverage in turn encouraging more structured products, all feeding into each other and basically creating a vicious circle while you had a huge pool of assets trying to search for returns, and creating essentially a situation which, when you put it into a global structure with a very liberalized, light touch regulatory environment and technology which kind of turbo boosted this thing, created something which is extraordinarily fragile and highly interconnected. It really represented, in effect, a failure to sort of connect the dots and people to see we're essentially stretching this elastic to its absolute limit without any due concern as to the fact that at some point it was going to snap. There was a fundamental misunderstanding or lack of appreciation of the distinction between risks and uncertainty. People felt that there was risk that could be calculated, so they were using models which are totally inappropriate. There was a belief in a log normal world, when the world was completely nonlinear, and made even more nonlinear by a lot of the behavioral issues that followed. The lack of appreciation in either academia or the financial markets of behavioral considerations and how these fed into the markets, and all of it basically led to what it was. So we had a crisis which was massive, and I think this, to me, and just very, very quickly, you can see, if you look at it in terms of leveraging, for example, this is just a picture of the increase in the leverage in advanced countries compared to emerging markets. Emerging markets had the Asian crisis and obviously the Mexican crisis earlier on. After that, they basically ceased to leverage. The developed countries started leveraging dramatically, and particularly in the last few years, there's a massive increase in leverage. What economic purpose did that really serve other than purely a financial one? If you look at, for example, another measure of indirect leverage, but also complexity in the markets, the size of the derivatives markets. Derivatives markets at the turn of the century were around less than 100 trillion in size. By the time of the crisis, we're talking about a market which is in excess of $500 trillion in derivatives. Huge degree. And essentially, derivatives are, by and large, a very highly leveraged way of playing the financial markets. If you look at the repo markets, which are a kind of an indirect measure of liquidity and also the securities markets, again, nearly a five-fold increase in size. So really huge growth in financial markets, far greater than growth in GDP, faster growth than any real economic factors underlying the economy. So purely financial growth for the sake of it. If you look at, for example, the Eurozone, all of this basically led to a period, on the left-hand side, you can see where credit spreads for Eurozone governments basically collapsed. So you had Germany and Greece basically trading as if they were the same security and trading at 10, 15 basis points over German bunds. And then subsequently we saw they went to 4,000. So, I mean, dramatic changes in perception. So, I mean, a world on one side which is basically the sort of, whoops, sorry. Maybe I have to, I don't know what I'm done. Okay, there we go, sorry, let me go back. A world which basically suggested a high degree of stability and liquidity and etc. And then suddenly a world which collapsed and went completely the other way. And again, this is just a summary which came from one of the works of Reinhard and Rogoff on basically if you look at the size, measure of the size of catastrophes over the financial crisis over the last 100 years. And again, this one was right at amongst the top in terms of a sort of composite measure of that for what's worth. Now, what are the lessons for this? And I think that really takes us to the core of what we're going to talk about. The lessons are one, that in my mind, that markets are fundamentally not efficient and self-correcting. And I think, I'm sure that many of you would agree with that. They're inherently unstable. And why are they inherently unstable? I think in the academic literature, there's plenty of those that would support this, people like Minsky and Keynes and others, and that market efficiency doesn't necessarily mean market rationality. Individual rationality doesn't equal collective rationality. Individual behavior is not entirely rational. There's a whole series of reasons, and I'm certainly not going to be trying to give you a sort of a rigorous academic presentation of that. But when you're living in it, you can actually see how irrational markets can actually be and how unpredictable they can be, how asymmetrical information can be, and the sort of perverse incentives that exist at any point in time, all of which were accentuated by the fact that the markets for a 10-year period were continuously leveraging, and basically the elastic was being stretched further and further and further. So when something went wrong, it went wrong in a big way. Fundamentally, one of the key issues why this was not identified was the risk models that we used were completely inappropriate. They did not factor in behavioral factors, market psychology, the interconnectedness of markets. Fat tails didn't exist. We had normal distributions. And the irony of a normal distribution was that, and I was part of it, in 2007 you look back 5 years, you take 2 standard deviations, 3 standard deviations, the market all been going in one direction, so the risk was going down, so load up more. Mm-hmm. And that's why leverage was going up, because your risk was going down. So it was completely pro-cyclical, and everybody believed in it, and everybody was basically playing that game. So the notion of fat tails and the fact that we didn't live in a log normal world was something which is completely alien to the financial community and to the practitioners in the market at the time. And maybe part of it was cynical because it suited their book. Part of it, I think, was just that was the perceived wisdom that existed at that time. And obviously there's been a lot of discussion about black swans, etc., and now everybody's beginning to focus on this sort of stuff. We had correlations which everybody thought that events were not correlated. In the middle of the crisis, we had correlation of 1 across the board. I mean, I sat in my desk at one point, and Barclays stock price, which was £8 at one point, was trading at 49p. Everything was completely correlated, and there was nowhere to go. Literally nowhere to go. You could not find everything. And liquidity basically dried up because everybody was trying to run through the door, and having leveraged 10 times as we've seen it, that means people are 10 times fatter trying to go through the same size door. It just didn't work. So you had basically risk models which were completely inappropriate for that time. And the costs of this were huge and really catastrophic. There was, and I think all of this basically takes to the whole point that the light touch and prescriptive type of regulatory environment that we had, which is very light touch and really box ticking, or you're doing very simple things, etc., and a very simplistic view and attitude towards risk and the financial system as a whole, was completely inappropriate and just did not reflect the realities of what had emerged over the last 20 years in financial markets. Everything had been going towards more and more light touch, more and more less regulation at a time when the markets are becoming more and more interconnected, more and more complex and in some ways much more and more less transparent in the way they operated. And we sort of believed again that markets were being very transparent because you had mark to market and prices, you could see observed prices, but behind that you had a huge degree of opacity, and that's exactly what happened. I think one interesting graph is in my mind is this the VIX index, which basically measures the volatility of the S&P, and that gives you an idea of what was happening. Basically, during the middle of the crisis, we had 1 in 100-year events happening every day, you know, and that was what was going on. So there was something fundamentally wrong. And the VIX index here at one stage nearly hit, it was around 90, which basically means that you're saying that the whole of the S&P, okay, which represents today $18 trillion in market capitalization, could move 90% on an annualized basis based on 30-day volatility. And if you take it on a 30-day basis, you divide by 3 or whatever it is, you end up with a move around 30%, 25%. So a market representing $20 trillion worth of equity in the world, moving up and down 20%, 25% during the course of a month. So basically, it was just total pandemonium. Now, let's move on to the regulatory response. And I think it was clearly a wake-up call. I think the good news was that people recognized that we were facing a catastrophe, and I think that's the only reason why the world did not fall apart and was not much worse than the Great Depression, was the fact that governments moved very, very quickly and responded. And if you actually look at the response, I think the responses, the numbers that I've saw recently were something like the response of the EU countries was like 18% of the GDP. The US was 73% of the GDP in terms of providing liquidity to the financial markets, and the UK is around 74% of GDP as well. So massive infusion of liquidity. This is not cash. This is not in terms of equity, but in terms of just providing liquidity and support to the markets to basically prevent this thing from collapsing. The G20 gets together in 2009. They basically decide, look, we've got to do something about this, and we're going to come up and change the regulatory environment. So what did they do? The key focus was basically to make the system safer, which is absolutely make a lot of sense, and secondly, to eliminate too big to fail. This became the key issue driving all of the regulatory environment. And the components of the regulatory environment, there are a number of key components in doing this thing. And I think, and I'll come to that in a minute, I think what is both a good and a bad thing is that I think the good thing is they identified a whole series of different initiatives that became taken. The not so good thing was that there really wasn't an overriding vision of what the new regulatory, what the new intermediation world should look like, and how we're going to try and regulate it. They basically dealt with little bits and pieces of it. We've got to make banks. How do we make a bank resolvable? How do we make a bank safer? How do we deal with the derivatives problem, etc., without looking at this thing holistically? And these things all have interlinkages together, and I'll come to that in a few minutes. First set of measures were to make banks safe. And the biggest change on that side was obviously the recapitalization of banks. And the amount of additional capital that's gone into banks, perhaps to your surprise, today, on an equivalent basis with Basel I, banks require anywhere between 8 to 13 times the amount of equity that they have. Now imagine, for example,
the times that they have or
have. They need it at that time. Okay. So if you need a 1%, now you need between 8 and 13% of basically core equity. Now imagine if you went to a manufacturing company and you told the owners you have to increase your equity 13 times. That's pretty significant, okay? So not saying it's wrong or anything like that, but it's a very transformational change in the amount of equity and that banks have to hold. Liquidity ratios. So resilience was basically through dealing essentially with on one side with equity, and secondly also dealing with liquidity and term transformation. And liquidity was also dramatically increased, the amount of short-term liquidity that banks have to hold on their balance sheets to avoid the sort of problems we have, and also the amount of term transformation that banks could do through one was the liquidity coverage ratio, and the other one is the net stable funding ratio. If you look at a bank like Barclays, prior to crisis, we held about 30 billion pounds in liquidity. Today we hold 130 billion pounds in liquidity. Now, imagine again what the impact that has. Liquidity means cash earning very little money. So that's pretty transformational. Doesn't mean it's wrong, but it's pretty transformational. Leverage ratios were introduced for the first time. Leverage ratios had been neglected because people felt they were very smart before 2007 and said, look, we've got these very fancy risk models. We use RWA, risk-weighted assets based on VAR models and things like that. And of course, all those went through the door, and people realized those didn't work. So basically, leverage ratios were introduced back as a very crude measure, because the problem with leverage ratios basically says you can have X number of assets against X amount of equity. It doesn't tell you anything about the quality of those assets. If you've got gilts, it's very different than lending to high yield. But they've introduced that as a backstop because they felt that the more sophisticated measures of risk really had failed in many ways. So we need to basically have other means of trying to support that. So all those things went into trying to make banks resolvable, and that's clearly a very, very positive development. The other area is basically was the whole question of resolvability of banks, and that meant that it comes to the whole question of too big to fail. Because at the end of the day, if a bank is not too big to fail, who cares? You know, we don't worry about whether some company producing widgets fails or not. That's their problem. As long as they're it's basically it's not systemic. So the key issue became to make banks not systemic, so that basically they could fail, and if they failed, they could fail in an orderly way. You could pull this thing apart without actually creating a systemic problem, and that led to a whole series of issues of living wills, for example, and most recently what is called TLAC, which is the total loss absorbing capital, which is basically an additional layer of capital which is introduced, which goes beyond equity. And that is that now the view is that not only banks have to have equity, but also a layer of debt which can be bailed in if a bank goes under. And why? Because A, it provides additional security, but also it means that bondholders now also have an interest in keeping their eyes on what's going on besides the equity holders. So you've got two sophisticated groups of investors, hopefully, keeping an eye on risk, etc. And TLAC right now, the proposition has been recently introduced, and that requires banks having anywhere between, it's basically 2 times their capital ratio in TLAC. So if your capital ratio is like 10%, TLAC is going to be around between 17 to 20%. So you have 20% on the balance sheet of a bank now can be technically bailed in, directing. There's other stuff that can be bailed in as well. Third area was market structure. We saw the huge growth in derivatives. The problem with derivatives was it's completely over the counter. And nobody exactly knew what the size of these things are, the interconnectivity, etc. Now that's all being put through, all the standardized derivatives are being put through exchanges, and it's going to be completely transparent in terms of pricing, in terms of volumes, in terms of activities, etc., through what's called central clearing bodies, etc. So I think that's going to make the whole derivatives market a much more transparent area. Conduct. And then in terms of other areas within market structure, you've had various rules in Europe. I'm not going to bore you with MiFID and other things which talk about how particular security markets have to trade, what sort of venues they have to use, whether exchanges, off exchanges, how the off exchange venues are going to be managed, transparency in terms of price, before, post, etc. A whole series of regulatory initiatives. Then there's been basically the whole question of conduct. And on conduct, there's been a whole series of initiatives taken in there, going from, for example, deferral of one of the key issues that was felt that was driving this thing was sales commissions, for example, eliminating sales commissions in many cases. Secondly, in case of bonuses, now bonuses are being capped. There's deferral of bonuses, there's clawback of bonuses, etc., to make people much more engaged and really party to the sort of decisions making. The supervisory framework was adapted basically to taking, in the case of the UK, and Europe is not dissimilar, taking out conduct on one side, prudential on the other side, and then adding finally a third element, which is macroprudential, which is very, very key, which is something which has been completely neglected. And I think macroprudential has 2 elements. One is a global issue, which maybe it's the IMF that really have to worry about it. There's also a national issue of basically asset bubbles being developed in the housing market, etc., and how do you try and manage those things so you don't end up in a situation where something can blow up and then drive the whole system down. Within Europe, we've had, with the crisis then moving on to Europe, we've had major changes there. We've created a banking union in Europe. We have now the ECB is essentially the lender of last resort for all practical purposes, which wasn't the case. We have a single supervisory mechanism within the EU for banks. We're going to have a single deposit guarantee scheme. We've had stress tests and a whole series of other measures to try and enhance it. So it's a pretty dramatic and pretty comprehensive change in the whole regulatory setting, one from which is very light touch to one which really addresses, in principle, virtually every aspect of the financial markets, banks and non-banks to some extent. Yeah, on the cultural thing, let me maybe, and I think that's with David's work on that, I thought I'd just spend talking a little bit about that. I think one of the things that was also recognized in this area, perhaps more so by some institutions than others, was that there was a need for change of culture and to restore trust, because trust became a key issue. I think one of the key, if you work in a bank right now, you verge on feeling that you're a criminal, and frankly, very few people are prepared to listen to anything you have to say, because they feel that your views are purely self-serving, etc. So that's a real problem, and it's understandable. It's a product of the crisis itself, and so one of the key areas for banks has been to try and restore trust. And trust, I think we recognize right now that trust is very, very critical. And some of the points that David in his book brings out, the whole question of product complexity, the fact that many products involve commitments over time, lack of face-to-face contact, etc. All of which require people to really behave in a way which engenders trust through basically not only focusing on the spirit of things, but also not only the letter of things, but also the spirit of what they're trying to do. And the whole question of intelligent accountability and strong trust, which are areas that have been developed. And there are clearly obstacles to trying to move this agenda forward. For example, the primacy of shareholder value, the personal incentives, etc., have all played against it. But I think a lot of changes have been introduced to try and address these concerns. And I think right now, there's no question, if I certainly not come to what we've done at Barclays in a few minutes, but there's a very strong move right from the top of all institutions to embed strong values and culture, to try and use that as a means of trying to regain trust with the public and with our external stakeholders. I think the question is going to be how long it's going to take to embed within institutions, and I think these things do take years, and I think we've ourselves said it's probably a 5 to 10 year journey before these things get fully embedded within an institution and become internalized in the way people think and behave. Just to give you a sense of the regulatory agenda, this is a list of all the directives that are being implemented, being negotiated, and still to be proposed in the EU alone. Now, each one of these can be 10, 20, 50, 100 pages. And our estimate is that probably we're talking in total, by the time you finish with rulemaking, around 60,000 pages of rules that are going to come out of the regulatory environment. So this is a pretty awesome, and it covers virtually every aspect of any, both on the asset side, liability side, etc. And at the point I made about capital, you can see that, for example, if you look at Basel II, and you start adding up all the additional levels of capital that are being introduced, and also the way in which risk is being measured, which is a much more not onerous, but it's a more comprehensive view of risk. Then capital ratios, if you could live and be within the regulatory remit with 1% core equity in under Basel II, now you need to have between 8 and 13%, depending on whether you're just an ordinary bank, or what's called a G-SIFI, which is a large bank, which is structurally important. So again, these are quite large numbers. Now, what does this all mean for growth, which is really the question that we have at hand? I think clearly, in the short term, it's positive, because the previous regulatory environment was not fit for purpose. It did not support sustainable growth, and we had a crisis. And it was clear that the markets left to their own devices, banks left to their own devices, financial intermediaries left to their own devices, could not generate a world which is going to be stable and sustainable. And it's not because there were, I think, evil, etc., but there were forces at play, incentives at play, which led them in a certain direction that basically fundamentally resulted in the type of instability, over-leveraging that we saw. So the changes that have been introduced, as comprehensive and as detailed as they've been, have certainly restored confidence. And if you look at spreads in the markets have declined dramatically. The VIX today, instead of trading at 90, is trading at between 10 and 15. Asset values are record highs. Growth has stabilized, certainly in the UK and the United States. Europe is a slightly different situation, but it's beginning to sort of again show signs of life. But I think the European situation had two elements to it. One was the financial crisis, but also had the fact that the European project itself was a very imperfect project. So under a crisis, it came under stresses that other jurisdictions did not come into. We now have a far greater degree of transparency in terms of the financial markets, in terms of the derivatives markets, and certainly even greater as we move forward. The repo markets, we're going to have a depository where we're going to know the size, volume of things, etc. And even as far as bankers are concerned, there is I would say, a gradual. Certainly, the lack of trust is not getting worse. It's stabilized, and I think in some cases beginning to improve. And that's the surveys that we look at, by and large, are on the whole positive, and that again is a good thing. In the case of Europe, the banking union has had a dramatic impact in terms of separating credit spreads within the banking sector, and the vicious circle that existed within the sovereigns in the banking sector. Credit spreads now in Spain are 1.5%. When at one point they were 7%. So again, we're beginning to see really a normalization of things, and the balkanization of funds is beginning to decline. So on this basis, one would conclude that regulation. We've regulated, we've come up with a very comprehensive regulatory environment, so this is clearly compatible with sustainable growth, because the previous wasn't, and that's it. So the question is the job done, and is that it? And I think one other interesting figure, just for your sake, is that there was a study done by the Basel Committee, which showed that the mean financial crisis cost 60% of national income globally. And if you assume a 5% probability of that happening in any 1 year, then the GDP cost of a financial crisis is 3% of GDP. So one way you could very simplistically argue is that better regulation has actually given us 3% of sustainable growth, which we wouldn't have had. So that's obviously very, very simplistic. Now, the question is, if we look at the medium to long term, what does this all mean? And I think that's where I think the question is a much more nuanced one. The problem, and I alluded to this earlier, is that the regulatory changes that we've introduced have all been, by and large, I think, good and in the right direction. But they have been introduced very much in a fragmented way, in a sort of addressing very specific issues. It was not really designed as a complete vision of, look, this is where we want the financial intermediation process to look like between banks, capital markets, etc. And this is what the whole regulatory environment has to look like. We've tried to deal with specific elements within the banking. As a result, what we've seen is a number of things. One is that the cost of intermediation per se has dramatically changed. And I think the fact that, as I mentioned, your capital ratios go up by a factor of 8 to 13 times, the cost of intermediation dramatically changes. The compliance requirements on banks, when you look at, you have 60,000 pages of rules that you have to abide to change. There's a study done by PwC, they say 50% of CEOs' times are being taken up on compliance issues and on regulatory issues. Now, this must have a negative impact in terms of, their ability to manage their firms and look for growth. At Barclays alone, we have over 2,000 people dealing in compliance. And today, the hottest area in the market, if you want to hire people, is compliance. People are just jumping from one place to another at significantly higher compensation levels. So the resilience that we've built has come at a significant cost in terms of the business model itself and the cost of the intermediation itself. That's one issue. Profitability has clearly been dramatically impacted. If you look at profitability of most European banks, they're down from the mid-teens down to 5, 6, 7%, depending on which banks you take. Very few of them earn more than that. And that's well below the cost of equity. So that's an issue which needs to be considered. Risk management products are becoming, banks are more and more pulling away from providing risk management products, derivatives and other areas like that. We, for example, have taken a whole section of our derivatives business and basically put it in a non-core area because the capital requirements are so onerous that it just doesn't make any sense for us to do that. More importantly, we basically have this intersection between bank regulation and the capital markets. One of the consequences of the significantly higher levels of capital within the banking sector and lower levels of profitability is that banks have had to dramatically reduce their inventory of securities. If you look at, for example, securities held by banks, they're down around 70% right now from the peak.
Yeah.
Now, if you're down 70%, and the volume and the amount of assets that is being managed is still the same, which in fact is growing. We have $70 trillion worth of assets that are being managed by institutional investors. 70% down in liquidity, in inventory. The question is, what does that do for the liquidity of the markets? Right now, it doesn't matter because interest rates are very, very low. And there's a huge amount of, the credit spreads are low, volatility is low, so it doesn't matter very much. But what happens when that basically changes, and how are we going to deal with that? And I think that's a major issue, which again is a byproduct of what we've seen. The other one is basically that the whole process of trying to improve the resolvability of banks, which again is it's exactly the right thing to do, has resulted in balkanization. The Americans have come up with what's called Rule 165, which says you have to have an intermediate holding company in the U.S. into which you have to put all U.S. operations, which has to be completely separately capitalized as if it's a U.S. bank. So the notion of having a global bank sitting in London with operations around the world, with all its capital centrally managed efficiently between these as they need them, is becoming less and less a reality. You're going to have localized entities. In the UK, for example, we have ring fencing, which has been introduced. Again, ring fencing, very noble idea, etc., and there are many benefits from it, but one of the consequences is that you basically are fragmenting your capital structure into different entities, which means you need more capital. The cost of intermediation goes up with it. So the issue then the whole new regulatory environment raises is that, what are the sort of cumulative consequences of all that we're introducing? And the reality is that nobody really knows at this point in time, because a lot of these things are just being introduced as we're going through time. And secondly, they interplay with each other. As I mentioned to you, increase the capital requirements of banks on their trading books, it has an impact on liquidity. You don't see the impact on liquidity right now because the markets are very, very well bid, etc., and interest rates are very low. But once that changes, what impact that has, and what are the consequences on growth? The other thing, for example, is that, and if you can I can just show you on this one. This is, for example, a measure of the amount of the balance sheet of banks in Europe, the amount of risk-weighted assets and total assets they have. It's been a sharp decline in the European markets. Now, in the medium to long term, is this going to have a negative impact on growth? You'd have to assume it's going to have some impact. How much of it is difficult to know. It depends to what extent this is substituted by other means of intermediation within the financial markets. But as I mentioned to you, intermediation in other areas has also been hampered because capital markets need liquidity, need inventory, need banks to trade these things. If you're hampering that, then you're not allowing a transition from banks as a form of intermediation to other non-bank or capital markets as a form of intermediation. The other is, for example, if you look at this is an interesting chart on global integration. Global integration has increased dramatically over the last 20, 30 years, but there's been a very sharp decline in global integration, according to one measure at least, as a result of the crisis and the changes that are being introduced. Now, again, one would assume that the more integrated global, the more we have international capital flows, the better it is for the allocation of capital efficiently worldwide, and the better and more positive impact it would have on growth overall, or at least potential growth. But that's clearly been an impact. So let me then move on to some of the issues on a little bit more detail on the growth point, etc. And I think that the key point is that clearly, if we want to have growth, we all agree it has to be sustainable. And I think for sustainable growth, we need to, on one level, manage macro imbalances, and I think that's where macroprudential regulation becomes very, very critical. And we need to also manage leverage, and I think that's where microprudential leverage regulation becomes very, very key. However, we also need to make sure that whatever we are introducing is not only compatible with sustainable growth, but also maximizes potential growth. Because it's fine for us to have sustainable growth, but if it's only at 1% or 0.5%, whereas potential growth through slightly different regulatory environment could be multiples of that, then we're clearly giving up a lot. And I think we need to focus not on sustainability alone, but also on the impact that it has on potential growth rates. And there, to try and achieve the right balance, I think we need to look at the current regulatory framework that's been set up through a number of different lenses. One, is it proportional? Is it internally consistent? Is there international consistency? And we also have to look at the transition process, because we are going from one world to a different world. The world we had in 2007 is a very different world than we have today. And there are transitional costs, and very few people are actually spending much time looking at how this adjustment process is going to happen. And managing that adjustment process is really quite critical. And all these things impact in different ways across different jurisdictions. So, and the point I made earlier is that the current regulatory environment has been put in place. It's been very much piecemeal, and it's not really taken a very holistic view. So this is really what I think really we need to focus on. And if we look at some of these points in more detail, one is basically the whole question of proportionality. We need a regulatory environment has to be something that can be managed effectively. And I mentioned to you the whole question of 60,000 pages of regulation in EU, 30,000 pages of Dodd-Frank, etc. Can you have banks function effectively and efficiently with that degree of oversight and micromanagement? And are there better ways of trying to regulate banks without getting to that level of granularity? And that really takes you to questions of trust. It also takes you, in my mind, to the whole question, which I'll come to in a second, of resolution. Because frankly, if a bank, we don't go and tell General Motors or Jaguar, every time you open a door, you have to open it slowly because you might hit a worker, etc. You basically, you have certain rules you set up, and then basically if the company does things which are foolish and it goes bankrupt, and we just move away from it. If you try and micromanage everything, then you basically can paralyze or severely limit the ability of an institution to function. So the whole question of simplicity of regulation has something which we need to really, really focus on, and I think now we're beginning to see that. And with the new Commission in Europe, is really sitting. One of the tasks they've put for themselves forward, and they have, in fact, the Vice President to do this, is to look back and try and look at the whole landscape. Can we simplify things? Can we, really revisit some of the things that we have done? Secondly, proportionality raises itself in the question of capital and resolution. Because if we truly believe that banks can be resolvable, then we have to be less worried about resilience. They have to be resilient because we don't want to go bankrupt every day. But frankly, you can be more relaxed. If you don't think you can resolve a bank, then yes, you have to have a very, very robust structure because of the externalities involved in the financial sector, etc. That trade-off, I don't think, is necessarily been given sufficient weight right now. Because right now we're loading up on the capital, we're putting in TLAC, etc., etc. And then we're also trying to develop a process which allows us to fully resolve banks. And are we really managing that trade-off effectively? Securitization is another interesting about proportionality. A lot of people blamed securitization for the crisis, and that's because it allowed something to happen in a way which was very inappropriate. People were able to originate assets which are not particularly good. They were able to securitize it, sell it to somebody else. There was no accountability, and there's so many different people involved, and also securitization created very complex assets which polluted pools of assets, which then led to a lot of the problems. But securitization per se, as an instrument, is a very, very important and very potentially very powerful instrument. And now again, there's a recognition that the initial response to securitization, which was to say all securitization is bad, is not right. There's good securitization, there's bad securitization, and we need to basically try and find the right balance and support good securitization, because good securitization can allow banks to liquefy parts of their balance sheet in a very effective way, mortgages and other things, and open up their balance sheet to lend for in areas which banks are particularly well suited to do as opposed to the capital markets. Then there's a question of internal consistency. And I think on that, I would like to raise two issues. One is, and I think fundamentally, is the whole question of if you look within, for example, capital markets, and we'll come to that in a second, there's a lot of focus. For example, Carney in his latest speech was talking about the need to diversify the intermediation environment. That means basically moving away from banking and more into capital markets. But to grow capital markets, one of the fundamental difference between capital markets and banking is liquidity. Capital markets have securities which are tradable, banks do not. Now, if we're basically hampering liquidity, then you're hampering the ability to develop capital markets. So that internal consistency is basically not adequately being addressed, because the whole question of liquidity was never really considered across all the different measures that are being taken. It's basically a byproduct of lots of different things that were being taken. And also the internal consistency between looking at capital markets, banking, and shadow banking on the other side. How do all these things fit together? And if we look to the future, what is the right balance between these things? And is the current regulatory environment providing that right type of balance? Then there's international consistency. There are huge differences in terms of, not necessarily at the fundamental level, but at the practical level in the application of regulatory changes between the US, between Europe, and some of the Asian countries. Mutual recognition of the regulatory environments that are being set up. And this means that unless these are resolved and resolved quickly, you're not going to be able to trade between each other. You're going to have restrictions. For example, right now, technically speaking, all American central clearing parties are not recognized by the EU. So a European company cannot engage in a derivative in the United States. Now they've extended that period for this issue to be resolved, and there's vice versa. So you have a global market where derivatives are traded, but if you can't trade on each other's exchanges, then the whole thing basically begins to collapse very quickly. Now it's because each party has to say, look, I recognize your regulatory environment as being equivalent to mine. Otherwise, you're going to have double regulatory environments. You're going to have to not only be able to have regulations which you are able to meet in the US, but you have to meet the US, the Americans, and your Asians, etc., and it's going to be impossible, frankly, for an institution to work with. Finally, there's the whole question of, that I mentioned on the question of the transitional process. I think there we need to basically really spend much more time in looking how we're going to move from one environment to another environment in a way that has not been done so far. Now, I think that the fact that the current regulatory environment is not addressing the growth issue, I think can be seen in two very important developments. I think, in short, what we've seen up to now is that regulation has been driven by the overriding objective of creating stability. Growth was not a factor in that picture. Nobody really added the growth as a dimension. Having now created stability, I think people are beginning to recognize that we need to focus on growth. If for no other reason, if we don't restore growth, certainly in some jurisdictions, we're going to undermine stability. And I think the biggest example of that is Europe. Europe, there's a real risk that we're going to have a 1%, what's called a 1% nominal economy. Europe growing at 1% nominal terms. If Europe grows at 1% nominal terms, even if you stick to the master criteria, the debt situation in Europe is totally unsustainable and the whole place will blow up. So we need to have growth rates, nominal and real growth rates. So people are now beginning to recognize that this is very, very key. And one approach has been basically to try and to adjust for this thing by introducing to introduce new initiatives. One of them is Capital Markets Union, and I'll spend a little bit of time on that in the next slide because I think that's really quite important. But also, in the case of Europe, to review the whole regulatory set of measures that have been taken to try and see to where extent these are actually anti-growth and where the measures can be taken to try and improve the existing. There's been a move to try and pump in money through the $350 billion investment program in Europe as an alternative while we try and sort of sort out the intermediation process itself. In the UK, a whole series of measures have been taken, again, alongside. But again, it's not to try and to enhance the intermediation process, but really to supplement the intermediation process by trying to get credit to SMEs, to venture capital companies, etc., to try and move forward. In the case of Europe, I think the key element, and I think this is important because it really is a very major initiative in the case of Europe, it also highlights the conflict that we have between bank regulation and the impact it has on alternative forms of intermediation. And that is the whole question of the Capital Markets Union. And one of the key initiatives of Juncker has been basically to say, look, we need to have a capital markets union. By that, what they mean is that we need to try and promote the role of capital markets in Europe. And that is really not surprising because historically 80% of intimidation in Europe has been done through banking and 20% has been done through capital markets. Now, Europe is not going to be the United States. United States is exactly the opposite. There's a good reason why it won't be the same. But it's clearly 20% bank, 80% bank is too much, particularly in this environment where we're putting all these requirements on the banking sector. So we need to find some alternative ways. And capital market is one way of trying to try and find an outlet for intermediation so that we can continue to support growth. And it's very important that and I think that the key with capital markets is that it's not only a question of providing additional financing and credit to the markets, but also capital markets provide a different type of financing to the markets, which is very, very critical for growth. And I think that's really quite important to bear, because companies that are growing companies need equity. And they need risk capital. And banks have historically not provided that. So in Europe, when we're trying to promote the growth of SMEs or medium-sized companies that are growth companies, we need to have actually instruments that are originated in capital markets. So now there's a big focus within Europe to find ways of trying to look at all the different ways in which the current regulatory environment has either hampered or has not supported the growth of capital market instruments with its bonds, with its privatization, private placements, securitization, equity offerings, etc., to try and redress that. So we basically create another engine for growth within Europe. And you can see this, for example, this is if you look at the Eurozone, the dark bars are basically bank lending, and the top bars are basically the bond markets and other non-bank lending, and compared to the United States, it's exactly the opposite. So there's a huge opportunity here for us to look at that, and we need to look at regulation in that context and how we can try and promote that shift from one to the other, and that's again part of the transition process that we're talking about. Let me end by just talking a little bit about Barclays, because I think it's something which I think exemplifies in some ways what is happening in the markets. One of the first things that after the crisis, and we had the crisis, and then we had our own crisis with the LIBOR scandal that happened. We had a change in the management of the bank, etc. And one of the first initiatives that was taken by the new management was to address the cultural issue within the bank. And this was a very, very serious approach towards changing culture. One, we, for the first time, actually identified a purpose. What is the purpose of Barclays? Nobody. If you actually tried to find a purpose statement of Barclays, I don't think it really existed prior to this time. And the purpose was the purpose of Barclays was defined as helping people achieve their objectives in the right way. This became the sort of mantra for the group. Secondly, we identified values. Again, we'd never articulated our values, and we identified 5 sets of values. One basically is respect, integrity, service, excellence, and stewardship. So that became part of the whole thing. Third, we basically put in place the question of a balanced scorecard, looking at not only what we do, but how we do it, and assessing people on that basis. So culture became a big issue for us. Was never something which really was front page. Now it's everywhere you go in Barclays, you'll see it, and it's really a fundamental way of the way we assess people. Secondly, last year we came up with earlier this year we came up with a strategic review of the bank itself, to try and address the structural issues that the bank faces. And these, not surprisingly, have meant that we've had to right-size the bank, we've had to shrink the bank quite dramatically, and I'll show you some figures on that. We've had to exit a number of key businesses, we've had to focus on costs in the bank, and we've had to all of this with the view of trying to restore our return on equity, not to some sort of abstract number of 15-20%, but so it's more higher than our cost of equity. That's all we're trying to, that's our objective. So we're not trying to go to the old days where you said artificially high levels of return, but we're just saying we have a cost of equity, we need to be able to match that or increase it, otherwise why would shareholders want to put their money in us? And if you look at, for example, what is happening, our core Tier 1 equity has gone from, let's say, 37 billion to 53 billion. And if you look at our total equity, it's gone from 47 to 64 billion.
Can you do that a bit more slowly?
Yes, sir. If you actually... I don't know if this has
I don't think that works.
That's okay. If you look on the left-hand side, in at the time at the middle of the crisis, our equity was 47 billion. That included the blue part is basically core equity, Tier 1, and the balance is is basically core equity. It's non-equity equity. Could be sort of subordinated debt. Could be other forms of capital which are considered as equity. It's gone from 47 billion to 64. You can see the top section of the 11 billion has not changed, and the increase has been purely in pure equity going into the firm. So you've had a very substantial, nearly 50% increase in the amount of equity the bank has. Same time, the balance sheet of the bank has gone down from £2 trillion down to 1.3 trillion, and if you look at a group of assets which are now non-core, which we put on the side and we're getting rid of as quickly as we can, it will actually decline to less than £1 trillion. So having the size of this bank within a 4 to 5 year period and increasing the amount of equity by 50%. Now that obviously has a pretty dramatic impact on the economics of running the business, and you can see that on the left, where returns on equity have come down into what are now in the very low single digits. In fact, this year I think it's going to be around 5%, 6%, depending on how you want to look at it. The bottom set of numbers are interesting as well, as you can see how we're changing our risk-weighted assets. And our risk-weighted assets in 2008 were 430 billion. Now, but what has happened is that the risk-weighted assets have gone down, but the same assets, the amount of risk ascribed to them has gone up significantly because of the new risk models that are being introduced. So if you actually look at what our picture would have looked like in 2008, that number wouldn't be 400. On an equivalent basis, more like 700-800 billion. So we've gone from about 700-800 billion in risk-weighted assets on an equivalent basis down to around 400 right now, and projected to go down to 320 billion. So it's a massive de-risking of the bank itself. And I put this up as an example of not that it's good, bad, etc., but really the transformation that a bank like Barclays is going through. Now, Barclays is one of the largest banks in this country, one of the largest banks in the world, and what we're going through is not in any way unique. So the banking sector is going through a massive change of an adjustment of its risk models. Yeah.
Do you have data on leverage?
Yeah, leverage, it's gone from over 50 times, it was between 50 and 60 times, and now it's down to around 25 times and going south quite rapidly. So more than halving of the leverage, absolutely. That's the crude leverage ratio.
What's the current estimate of the cost of capital for Barclays?
Low teens.
As much as that.
Yeah. Now, obviously, the cost of capital, in theory, is over time may come down if you believe in the Montgomery-Miller proposition, etc. As you begin to de-risk, etc. But I think today our cost of capital will be in the low teens. So we're still some way away, and our target is to try and get there by 2016, 2017, 2016. I think is our objective of achieving that. So that's where I'd like to end with, and basically, I guess what I'd like to leave you with is one, looking at from the sort of from our side of the fence, we fully recognize that what we had prior to 2007, 2008 was not sustainable. We needed to have a new regulatory environment. We embrace it. We think it's absolutely right and fully support it. We, on the other hand, believe that having put together a very, very extensive regulatory framework, a new framework in place, we do need to sit back and reflect. And in my mind, there's no question that there is significant room for fine-tuning that regulatory environment. It's not really surprising. And in that way, not only make sure that growth is sustainable, but also to try and achieve a much higher level of ongoing growth and potential growth within the economy, and increase that. Otherwise, I think we will hamper potential growth. But having said all that, I think that what we've gone through, I think in my mind, raising questions. And one is, to what extent are we over-engineering regulation, and what sort of perverse implications that has? And I mentioned to you the thousands of pages of regulation, etc. Is that really, do we need to have that? Is there a different way of trying to regulate banks than that and achieve the key objectives that we have? Secondly, to what extent have we been been very reactive, which I think we have been, to a past crisis without really giving due attention to what's coming on in the future? And I think historically bank regulation has exactly been that way. We've been reacting to situations in the past without really looking in the future. And I think we need to really sit back and reflect, what are the existentialist risks that we're going to face? I think one of them could be, for example, the liquidity crisis that we might have emerging from the asset management side of the business. Because if you have $70 trillion worth of assets and interest rates starts going up and everybody wants to go and basically adjust, it's not going to work. What is the appropriate level of liquidity that you want to provide in the markets? Should people be maximizing returns on a day-by-day basis in the asset management business, and the implications that has, or there should be a different world? So I think that's a whole question. There's a question of cyber. risks that we're facing, etc. Are we addressing those sufficiently well? The other one is the whole question of incentives. And I think the incentive issue is a very important one, and David's obviously spent a lot of time looking at that. And I think, as banks, we feel very conflicted, because on one side we are very supportive of deferred compensation, of paying people in shares, clawbacks, etc. We don't have a problem with that. On the other side, when we have caps put on bonuses, we have a problem, not because you might say, oh, well, they want to get paid more money, but frankly, how do we compete globally? Yeah. If we're basically competing with Goldman Sachs, Morgan Stanley, JP Morgan, they don't have any caps, we have caps, then we have a problem. Now, what will happen is either we have to increase our base salaries dramatically, which is a very stupid way of doing it, because that's the worst thing you could do, or you basically means that Europe, including the United Kingdom, has to leave investment banking. Now, that raises a very interesting policy issue, because if Europe doesn't have an investment bank, and Europe wants to increase the role of capital markets in Europe, capital markets, you need investment banks. So basically in that environment, you end up in a situation where the capital markets in Europe are going to be essentially managed or run by non-European institutions. From a public policy point of view, is that a wise position to be in? And is that more efficient? Is an efficient way of dealing with it? Because inevitably, large global investment banks are going to have a very different set of interests, and maybe also subject to very different political considerations in dealing with Europe than if you have European institutions. So I think it's a very interesting question there that needs to be considered. And finally, I think it's a much more fundamental issue, and that is the financial intermediation process as we know it today fit for purpose? And this, I think, raises two sets of issues. One is the whole regulatory issue, which we've been discussing, but also this is all happening at a time we're going through a fundamental change in technology. Yeah. Payment systems, you have PayPal, you have Apple Pay, all these things are coming up. Branch networks are basically beginning to disappear. You're beginning to move into capital markets. We've discussed that. Shadow banking is beginning to play a more important role. And I think we all need to really reflect and see, what is intermediation going to look like 5, 10, 15, 20 years down the road? And what type of institutions will be responsible for providing that intermediation? Because right now we have a thing called a bank. But is a bank going to be a bank? Or is it going to look something quite different? And what are the functions of it? Let's go back to first principles. And to what extent would you, if you were to create financial intermediaries, would they look like the ones we have today? And to what extent, as we, as an institution, go through this transformation, are going to end up where we are? Credit cards, how does credit cards fit into this whole picture of credit, etc.? And there's a whole very interesting set of dynamics going on here. So I've spoken far too much.